Good evening, everybody. Welcome to the September month's economy, market, and investment update called by us as E.M.I. Interesting day for the markets over the last few days. I'm sure all of you are interested to know what's happening and why it's happening. So let's start delving into that straight away, right? So if you take a look at the market this year, the markets have been very volatile. As you can see, this reflects to you just the 10-day period of the market between Friday and the 15th of September. So I was just wanting to take you through how the markets have been volatile. So if you see this as of Friday, as you can see, the 1 month returns only reflect a slight negative. That's the reason I put down the September 15th number there. And as you can see, 10 days ago, the 1 year return, only small cap was negative. Everything else was positive in the 1 year return. Just in these 10 days, which are actually what 4 or 5 working days for the market, you've seen that the entire large cap and the BSE mid cap has gone negative. The CNX 500 broader market has gone negative. And the 1 month returns are obviously the large cap. This is obviously because the FII outflows are largely in the large cap segment. So what happens in the last 10 days is something we'll address later. But if you then go back in time just a little bit and go back to June, you had a full red market. And in January, the beginning of the year, you had a full green market almost. So the markets this year have been extremely volatile, right? So what are the reasons for this? For understanding the reasons of this, let's look at some lessons from history. Essentially starting from the year 2019 right up to June 22 when we saw that correction, right? What caused the rise in the market in 21, which you saw the full green, and the strong correction by June 22, right? And the reason for this is that the Indian stock market is essentially dancing to the tune of the FPI inflows and outflows. So this graph here gives you a clear explanation where the yellow line that you see gives you the share of FII investment in our stock market as a percentage of the free float market cap. What is the free float market cap? From the overall market cap, you subtract the stocks that are held by the owners, like Mr. Premji owns Wipro shares, like that if you take away, which is roughly about 36% of the market, because that's being removed because you can't buy and sell in the non-promoter promoter holding, right? So in the non-promoter holdings, if you look at it, the balance 64% of the market, FIIs own about roughly 40%, and right from 2006, this number has been hovering between 35 to 45. Right? What happened in the market correction was that this 45 recently came down to 40. The other components who else owns are, of course, the domestic mutual funds who are currently at about 15-20%. You have the banks and FIs and insurance, other domestic corporates who are around that number. You have retail, which is around the number. All of them are each owning 10 to 15% kind of holding. It's the FIIs who are the biggest holder. And so when this movement occurs, which over the last 15 years has been between 35 to 45%, that movement is what is causing volatility in our markets in a big way. And this volatility, right, is essentially caused because there is a core FII which is at 35%, right? Is this 35 going to 45? So on an average, let's take it as 40. It's that plus or minus 5 from 40 going up to 45 or down, which we can call it as the hot money, which causes the volatility in the market. Now, why this hot money comes into India and why and when did they pull out of India? So there you will see the data here. I've picked a few select emerging markets here. And if you look at here, calendar year 19 is the first row there. And you saw that many of the markets got flows, couple of markets saw outflows, but India got the massive inflow of $14 billion. This is all in dollar million. So before the comma gives you the billion. The next year, in calendar year 20, you saw that it's a COVID year. An entire emerging markets saw an outflow except for India, which saw a massive inflow of $23 billion. In the next year, post-COVID year, you saw that the sharp reduction in the inflow from 23 billion to 3 billion. But if you break up the year in the table just below into the 4 quarters, you will see the first quarter was on run rate, normal run rate of a strong flow. Then the second quarter when it started dropping. In the fourth quarter, it turned negative $5 billion. And then in the first 2 quarters of the current year. Remember, we are talking now up to the period up to June 22 right now. You saw $14 billion of outflow in each of those quarters, right? So if you take those numbers, you will then get a scene that FPI outflows were strong in 2019 and 20, and the pullout started from October 21 till June 22. Why did that happen? Essentially, you can correlate it to the crude price movement in the world. So if you can see 2019-20, starting in the middle, can you see March 19? So September 18. So somewhere in between that, oil crashed from September 18 to March 19 from a level of 80 down to about 45. Then it went back up, but by and large, till the period of March 20, there was a soft oil price of the 60s, and then it dropped. What happened from October 21? If you see September 21, there's been a sharp rise in the price of oil. If you want to see this in percentage terms, the graph on the left tells you how the energy prices in 2019 and 20 dropped by about 40%, whereas in October 21, September 21, they rose by 100%. And a similar story was there on the right-hand side graph, which tells you the picture for food, metal, and overall commodities. All of them also reflected roughly the same, right? So you can generally call this as a commodity inflation time and a commodity deflation time. Now, the same graph, if you put it back on here, you will see that I have marked out in green on the right the commodity deflation time, and in red the commodity inflation time. So you can now make the thing that FPI flows, especially those hot money flows, are strongly correlated to commodity inflation or deflation. That is, when there is commodity deflation, FIs put money into India, and when there is commodity inflation, FIs generally pull money out of India. With this knowledge, right? Now, when you look at it, right, the money flow into India also reflects in the premium of the Indian market to the world, because they come in and the valuation. So if you can see in 2006, right, is when the Indian premium started. The one of those graphs, the light gray graph, is the premium with respect to emerging markets, and the dark blue graph is the premium with respect to the world market. And you can see India has been consistently above, but the movement of the PE chart clearly correlates with the inflows or outflows that we just discussed, right? So from the October 21, you can see the premium, how they have moved, and then the correction, right? So in that context, again, another graph which explains the same components, that within the emerging markets index, the previous one cobbled together the emerging market. Here now you break it up into China, India, Korea, and Brazil. You can clearly see that the India yellow is at a clear head and shoulder above the rest of the emerging markets in terms of its valuation. This strongly reflects the flow trend that moves into the market, right? So why did this pull in and why did the pull out take place? So let's look at it from a pull out perspective, because the opposite of that will tell you that they will put money. When oil prices rise, especially sharply, the fear of FIIs is that the first point, that Indian inflation would rise alarmingly. Second, that to counter that, RBI will have to do massive rate hikes. Because of this, consumer demand would get affected, because first inflation will eat into their income basket, and then the rate hikes will increase the EMIs, so GDP will get impacted from a declining demand. Then you have the fact that because of the import bill, India imports 83% of its oil, the trade deficit would go up, and naturally the fiscal deficit will sharply go up. So a rise in interest rates compared with the widening fiscal deficit means government's borrowing costs would rise, and its ability to spend on capital expenditure will also come down sharply, thereby impacting GDP growth. Corporate margins, because those sectors where they use oil or imported commodities to manufacture, like the auto sector, like the fertilizer sector, like the paint sector, their margins would shake because their input costs would go up, and maybe in a declining demand, they wouldn't be able to pass it on to their customer, right? And consequent to this margin correction, you will see that the stock market would correct sharply, impacting the FPI's returns. And finally, because we have to pay for this 83% of oil imports with dollars, Indian currency would weaken sharply, further impacting the FPI returns. So these were the reasons that FIs pull out money whenever there is a oil and commodity price rise. But in the Indian equity market, this pullout, FPI has got it wrong. Why do I say? When you look at the data of July 5th, right, which was the time after this sold. The markets were all red all over the world, whether it's Dow Jones or MSCI emerging market, China, various other Asian countries. But if you take a look at the 3-year returns, which were still positive, you saw that India had next to the Nasdaq the most positive return for investors. And if you take the 1-year return, right, India was still marginally positive when the whole rest of the world was negative. So clearly, Indian market did not fall as much as the FPIs thought would fall. So if they had not pulled out this money, they would have been in a much better situation, because wherever else they put the money, they lost even more, right? So this point is that the FPIs got it wrong. Why did they get it wrong? They got it wrong because certain common myths did not occur. First, Indian inflation we spoke about. When you look at it, actually India's inflation is dramatically different from the developed world's. When you say that, this graph, the blue line tells you the US, the Indian inflation, the black line tells you the US inflation. Today, they look similar at around 7 to 8%. But if you go back the history there, you can see that traditionally the US has been at 1.5 to 2% and now shot up to 8.5. India has been on an average of 7 and we are hovering around our average. So though the Indian inflation looks technically at the same level as American inflation, for us, this is the normal inflation we are used to, whereas for America, it's a 5 times multiplier of the inflation they are used to. Second, the nature of inflation in America, which is there on the left-hand side, tells you that 42% of America's inflation comes from housing, which is a demand-side inflation, whereas for India, 48% on the right-hand side pillar, you can see, 48% comes from food. Another 15% in gray comes from transportation and fuel. Both are supply side impact. So India's inflation is supply driven. America's inflation or advanced country inflation is demand driven. This is the second difference. The third difference here is that this imported rise in price, see, that's undisputed, right? You saw the oil price rise, you saw metals rise, you saw food rise. This had its impact in India on the WPI, which is the wholesale price index, but not on the CPI. Why? Because number one, corporates. So one of the things the FIS got right was that corporates would not be willing to pass on this increased input cost to their customers. So they absorbed it, and hence the retail prices of products did not increase. Second, the government took a lot of efforts here, notably cutting excise duty and absorbing it in their income, thereby not pulling on the full petrol price hike to the customer. And the second is in food and all of that, they banned export of sugar, of wheat, and all those things so that Indian prices remained low, which is what this graph tells you, that global wheat prices are at 3,250 per quintal, whereas Indian wheat prices are only at 2,250, 1,000 rupee per quintal. India got cheaper wheat, right? Because the government banned the export. So the fiscal measures of the government and the corporates helped not pass on this wholesale price inflation to retail inflation. The other thing here is the RBI, because this inflation came at a level above 6%. If the two yellow lines that you see are the RBI's comfort zone, they're between 2 to 6. So RBI tolerates inflation between 2 to 6 and doesn't do anything. But the moment it goes above 6, they do rate hikes. So RBI, when he saw the inflation above, did prompt rate hikes to keep the inflation also cooled off. Though because India is a supply side economy, as you just now saw, right? 48 plus 15 is supply side of the 100%. RBI's rate hikes were not mainly intended at controlling inflation, but for a different reason, which we will shortly address. But just bear in mind that RBI were also front-loading the rate hikes, also helped control inflation to some extent, right? But then India, with 48% being on food, our inflation is also dependent on the monsoon. And so far, we've been blessed to have a fairly normal monsoon this year. Hence, that has also helped to keep the inflation, food inflation, at normal levels, right? So that was on the inflation. So the expectation that India would go into rampant inflation was belied by the FIIs. The second myth was around the currency, where they thought that there'd be a huge weakening of the currency. In this period, currency only went from 76 to 80, which is what they felt. We know now it's gone beyond 82. We will address that as we come along. So this weakening of the currency, right? It has actually belied expectations, and India has actually outperformed many countries when it comes to currency performance. This chart here will help explain that. So what is the blue line here? The blue line here is the DXY. There is dollar versus X and Y. Dollar versus a group of countries. And then the gray line is the US dollar rate. As you can see, Indian currency has weakened to the extent of the strengthening of the dollar. So it's important to remember that India has not weakened more than the dollar has strengthened, right? So kudos must be given to RBI for maintaining the rupee at this exact level. And what is the logic behind this? The logic behind this, as you can see up there, the rupee's depreciation of the rupee on a 1 year may be 8%, but over a 3-year period is 11%. How is this justified? If you look at the right-hand side, the difference between the interest rates between America and India is 3.75%. That should be the annual rate of depreciation of the rupee, and hence 3.75 roughly over 3 years. So India has maintained its parity on interest rates vis-a-vis the US. Now, since we are aware that the rupee has now breached 80 and gone to 81 as of Friday, as you can see the table down below there. So now the 3-year depreciation has gone to 14%, but the interest rate depreciation as of yesterday is only 3.71. So what is this now telling you? This is telling you that the recent rate hike by the Fed and the RBI has not yet followed through with their rate hike. So as you know, RBI's policy is slated for the 30th of September. So the difference in interest rates hasn't moved much. It's only 4 basis points from 3.75 to 3.71, but the currency has weakened. So clearly, RBI will be expected to do some kind of a rate hike on 30th September to bring the rupee back to parity. So RBI is conscious of the fact that we must maintain that parity with the dollar. So this is a very excellent management of the currency. The reason the distortion has over the last, because RBI didn't want to make a mid policy because the policy is anyway due in a week. Where the RBI thinks the rupee should be rightly positioned, we will know post September 30th when they do a rate hike and the market readjusts to that number. But that being said, if you look at what the Indian currency has performed, it's exactly the middle of the emerging market pack. It's neither the worst performing currency nor the best performing currency. So RBI has made a balanced approach to the rupee. How was this achieved? This phenomenal performance of RBI despite many adverse factors. What are the adverse factors we are facing? First, we saw oil price doubling. That means dollar requirement doubled. Second, we saw that FIIs in this period have pulled out $34 billion from India. So those dollars also had to be supplied by RBI. Third, debt market FIIs, we see at the bottom right, 13.8 billion in 2020 and another 1.5 billion in 21. That means almost $15 billion was pulled out by debt market FIIs. So 33 billion by equity, 16 billion by debt, almost $50 billion of money flew out of India for which RBI had to supply the dollars. Then, what else? The key factor is that RBI was helped by the government in this case, because the oil that we were to import, RBI and the government of India suddenly switched to Russia. So if you see in January, February, the red line tells you the amount that we import oil from Russia. In Jan, Feb, it was very marginal, and suddenly we went 1,600% increase in the oil imports from Russia. How does this help? India has gained 35,000 crores by importing Russian crude at a discount. So the rest of the details are here, but if you go to this slide, this will tell you that thanks to the strong stance by the government of India in resisting the USA sanction pressure and buying Russian oil led to a double benefit, oil at 25 to 30% discount and a payment not in dollars, but in ruble or a barter mode instead of USD. So this was one factor that had helped the RBI in balancing the rupee's requirements. Second was the interest rate hike. I mentioned to you some time back that RBI front-loaded the hikes. They were not so much to control inflation as much as to manage the currency. Because as I mentioned, RBI has to maintain that interest rate differential, right? So they hike the rate so that the differential in the US hikes, we hike it, the differential remains the same. If you don't, then the differential widens, there is pressure on the rupee to weaken. So September 30th, we can expect another rate hike from RBI so that that parity between the rates is right to be maintained, right? So then this is what the RBI has done. As you can see here, this gives you a clear-cut indication that over the last 1 year, The Fed has actually hiked the 10-year rates have gone up by 2.25%, but India's 10-year GSEC has only gone up by 1.25%, indicating that there is room within the RBI to do a rate hike to manage the currency. The second aspect is that RBI used judicially its foreign exchange reserves of about $640 billion. They used about $80 billion to fight the dollar depreciation of the rupee. So this came to their aid in making sure that the rupee weakened only as much as the dollar strengthened. They could have used even more of this, but we want to maintain our stance that we should be a good forex reserve country. And even now, after this is done, we are still the fifth largest in the world in terms of India's foreign exchange reserve. So India's strength as a country has not been impaired because of the judicious use of FX reserves. The third thing which helped in this process is the encouraging of the masala bond issuance, as a result of which one-third of India's external debt is in local currency, which means what you don't need dollars to repay those loans. This again is a big strength factor for the rupee. And finally, RBI has recently announced the acceptance of payment in rupees for international transactions. So this will also help us to defend the currency. As I said, currently we are in between a Fed rate hike and an RBI rate hike, and hence the rupee is deflecting the depreciation. As soon as RBI announces the actual rate hike, the rupee will readjust and you'll see a retracing of the weakening. But RBI would have a target price in their mind in terms of the depreciation of the basket of currencies against which India measures itself. So this is called the real effective exchange rate, REER, and based on what they feel is where they will do the rate hike so that the rupee comes and settles at that level. What that is, we will know only on the 30th of September, right? Now, the third thing that we saw there was an expected impact on India's fiscal situation from this whole oil price rise. There, when you see, and you see the first quarter numbers, and those highlighted in yellow tell you that on the extreme right is what the budget estimate was, and the middle column, which is in yellow, is where the YOY increase. So the government is budgeted only a 6% increase in their income, but a 23% increase YOY has happened in their income. In the total receipts also, compared to 3, we've got 9, and they've spent the money in the right way, that instead of the 27% capital expenditure spent, they spent 57% on capital expenditure. So spending quality also has been maintained by the government, and hence fiscally we are reasonably comfortable. And this is on the back of a rising month-on-month GST collections and the fact that personal income tax grew 40% and corporate income tax grew 30%, which means by and large, people are making more money, more income, they're paying more taxes. Companies are making more income, hence they're paying more taxes. This also reflects to you the growth in the Indian economy. Right. And finally, to see that on a fiscal situation, India's external debt to GDP has actually come down over the year. So this means that India has not become riskier. So all of these are positives. So further, for India, central government is not the only government. There are state governments. And if you see the revenue streams of the state governments, all of them have been rising continuously month on month. Right. So overall, if you see in top of this, the expected market correction, despite the margins coming down, did not happen because the Indian equity market had a strong domestic flow support. So if you see here, the same table, this time in rupees, the time-wise table. Last year, during the COVID year, when the FIs were investing in India, domestic investors were pulling out money from mutual funds. Hence, mutual funds were net sellers in the market to the extent of 45,820 crores. However, if you see, and that continued in the first quarter of this year, but if you see when from October, due to commodity inflation, the FIIs started pulling out money. You saw that the domestic mutual funds were strong buyers in the market. So 45,951 crores in October, November, December, 71,000 in JFM and 72,000 the next quarter, saw a total of 1.9 lakh crores of purchases by domestic mutual fund, offset the selling by the FIIs, and hence the stock markets did not fall to the extent that the FIIs anticipated and they pulled out money. right? And this then is reflected in the volatility index of a stock market, which is in red, is much, much lesser than the volatility index of the global stock market. So the domestic flows support to the selling of the FIIs came and cushioned that volatility impact. And hence, putting back the slide, all those lines that are in red are where the FIIs got it wrong, and the line that is green is what the FIIs got right. So 7 of the 8 items went against the FII's expectations. Hence, the Indian markets outperformed the global markets for them. So enough of this history, and let's cut to the present, which is July 22 onwards. Now, when you understand the economic scenario, globally is the inflation dominating the scenario, and most importantly, the Russia-Ukraine conflict, which happened in October last year. So as you saw already this slide, you saw energy costs shoot up, you saw food and metal prices shoot up. In fact, year-on-year change in the electricity prices clearly reflects this cost increase. And this, when you now look at it in a historic term, you will see that over the last 50 years, whenever oil and energy costs have shot up, invariably in a few months, recession has followed. So this rise in October onwards in the oil prices itself heralded the arrival of a recession. And when such recession happens, US GDP actually drops to as low as -3%, and global GDP tends to 0%. But this recession then in a cyclical way actually causes crude prices to fall because demand collapses. So this is a cycle that the world follows, and hence today the situation is that with the inflation rising and they're heading towards recession, is it going to be a soft recession or a hard recession? The answer to lies in the fact that despite oil prices declining, as you saw, inflation is still stubborn. Why did I say oil prices are declining? As you can see here, the last quarter from April to September, oil prices have started declining. Right now, in that situation, why is this not coming? Because the problem for the advanced countries commenced well before the Russia-Ukraine conflict, and it was a man-made and self-inflicted. Why do I say that? When you look at the graph here on the left-hand side, you will see the origin of the inflation was in Jan 21 in a post-COVID scenario when it started with the supply chain disruption that COVID caused. But since the COVID also caused a shutdown of cities through lockdowns, demand also collapsed, and hence the Fed and other Japanese Fed as well as the European Central Bank, all of them gave away money to their people through quantitative easing and through rate cuts. So that led then in that first half to a inflation from supply as well as from demand, and hence inflation by September of last year prior to the Russia conflict was at about 5.5%. Then came the supply disruption from Russia-Ukraine war, which took the inflation from 5.5% to 8.5%. So the actions of the Fed and the central banks are given here. So on the top, you see in June 2020, they did rate cuts. You can see the 6-month, 1-year, 3-year Treasury bills rates have all gone into red. Whereas the Fed, on the bottom right graph, you can see from 2019, December 20, they pumped up. So the liquidity in the system was about 4.5 to 5 trillion. They almost doubled it to 9 trillion. So they fueled the inflation through the rate cuts as well as the liquidity pumping. But when the inflation went to 8.5, you can see that the US 10-year, September 15th, 3-year had gone up 160 basis points over the last 3 years, the 10-year yield. And in 25th, in these 10 days, it has gone up another 44 basis points. So we are sharply increasing interest rates to cool this, and they announced a quantitative tightening, which you can see in a dotted line there from 8.9 to 7.3. So this reaction, right, like I said, is man-made because they created the demand side inflation through their liberal rate cuts and their quantitative easing, which they are now trying to reverse through quantitative tightening as well as rate hike program. So then when you see, this is the way the whole situation has changed, right? Year by year, if you see through continuous years of rate cut, and finally now a sharp rate hike is happening across the world in the red line. And the rate hike, if you see, this also tells you about what the rate hike is going to do. So they expect that the circled ones, the implied rate, right, from 14th December 2022 they expect this to rise to 4.3, peak around March next year at 4.6, and then drop back to 4.3. Why do they expect this to happen? Because all these rate hikes are going to slow down demand and bring down. So that's what when you see here, right? In the central, that was the US central bank of 9 trillion. The world over, the G4 countries have close to almost $28 trillion of money. And that's what they're talking about, slightly easing going into the next year. That is the quantitative easing will be reversed and tightening starting. And the effect of the interest rates on demand is seen clearly in the fact that the housing, this is the Freddie Mac, which is the US housing loan agency, the average rate on a 30-year fixed mortgage dropped to as low as 2.5%. People are able to buy home loans at 30 years fixed rate, 2.5%. Naturally, it fueled that huge housing boom. That's why you saw 42% of US CPI is from housing. But today, the series of rate hikes has taken that 2.5 to 6% levels. So can you see? Naturally, this will cool down the demand for housing in the US in a big way. So in our view, then, with such a kind of sharp rate hikes and sharp collapsing of demand, it is going to be a hard recession. So what does this mean? In fact, if you saw 58% of investors in Bank of America's survey expect a recession in the US over the next 12 months. The same is the case with the actual earnings forecast of US stock market. You can see from a blue, they've all changed into red. So everyone is downward revising the earnings of companies listed in the US stock market. And in Europe too, the polls of the people before Russia-Ukraine war to now show a sharp increase in the probability of a recession. And manufacturing PMI, which is an indicator of the upcoming GDP numbers, are all trending down across US, Australia, Japan, UK, France, and Germany, right? And the Baltic Index, which is a good indicator of how cross-country trade takes place, is also down 60% on a one-year basis, right? Indicating that shipment and everything is going down. The global economy thus now reflects that with the oncoming inflation, a commodity deflation is now setting in, right? And so if you see the 12-month prices of commodities, steel has dropped 50%, palm oil has dropped 50%, and a whole lot of other metals have also dropped. Oil also has dropped 14%. Oil's drop is less because the OPEC. So if you see crude oil consumption in China, which is the biggest consumer of oil, has also started dropping. But when will oil prices correct? This table tells you that today, dual oil demand is about 100 million barrels per day, of which 70 million, 70% is met by non-OPEC countries. And OPEC has to supply the balance 30, is only supplying 28, thereby creating some kind of a supply shortage and keeping oil prices from falling. When will it fall? If you go back in time and look at the first column on this table in 2020, from today's roughly 100 million barrels per day, the oil demand was actually at 90. So a 10% drop in the oil demand led to a situation where there was a sharp drop for the OPEC from 28 to 23. So this kind of a time frame is when oil dropped to as low as $20, right? So a 10% correction in the world's oil demand due to a recession will lead to a start in a collapse. The oil prices have already reached around 80. They will come down further as the recession becomes more and more probable, right? So this is what, again, to show you the crude price, it's already come to a level of what, 80 odd dollars, right? So Indian market from July, when these commodity prices started easing, FPIs returned strongly. That is, history was repeating itself, right? And then when you see this trend, week on week, if you see fortnightly trend, you'll see that up to 15th July, FIIs were sellers when the oil prices were rising. When the commodity started easing, they became net buyers. Then you saw the last 10 days, so 19th September, the last 1 week, $3.5 billion have been pulled out. Why this pullout has happened? Has it happened because inflation is coming up? We will evaluate that in a bit. But right now, this is to show you that the reason that our stock market reacts to flows of FIIs. This $3.5 billion has led to another correction over the last 1 week, right? So now when you look at it, right, and see this situation, this back this table, now I've added a row for quarter to date from July to now. Despite that $3.5 billion going out in the last 1 week, quarter to date, India has still got $8 billion of positive inflows. So by and large, the story in times of a recession and oil price declining is that FII flows start coming back, right? From that point of view, if you see Indian markets' relative performance, right, Indian markets have been at a valuation premium for over 15 years because over the last so many years, we have consistently been that one country in the world which, except for the calendar year 2018, has consistently received positive flows from FIIs. This, as we saw, started actually from 2006. And because of this, if you see now that over the last 1 month, and mind you, this was data just before of last 1 month, Indian markets have outperformed all other markets. So though we are seeing a sharp correction in our market, remember that correction is worldwide and the correction in our markets is actually much, much lesser than that in other markets worldwide, right? And this, in fact, will tell you that India's P ratio with the world actually is rise in the last 1.5 years, and our market has outperformed Asia Pacific, overall emerging market, as well as the world over the last 3 months. Right? From that point of view, right, if you see that in the fall, up to Friday, Indian market year to date is down 1%, but every other country is down double digit, strong double digit. So India has seen the least market cap erosion on a YTD basis. And if you look at large cap, mid cap, small cap, in all the seed segments, if you compare the US, India, in all the three, our markets have outperformed the US in terms of a rise or a fall, right? And if you then look at the fact that on a against the US on a YTD basis, the US is down 19%. We were actually up 1%, right? Data is there till September 22, right? So is this sustainable, right? This India's outperformance, despite the recent correction, as I mentioned, we're still outperforming. Yes, because let's demystify some myths here. While the world may be a recession, is an Indian economy also looking at a recession? Look at the PMI numbers first. India's PMI, manufacturing and services are both above 50 and trending up, right? If you see the RBI survey on industrial outlook on employment, 4-quarter rolling, it's showing a far sharper rise of people, and industrialists are saying we are going to be hiring more and more people. Second is the business expectation index is also showing a V-shaped recovery over the next quarter, right? And if you look at the Indian economy's growth drivers, they are not related to the recession in the world. It's an investment-led growth story, starting with government capex, where government is midway through a 111 lakh crore expenditure on capex from 2020 to 2025. And in this quarter, they've lived up to that with a 57% increase in capex. And the highway construction is the one that is dominating and taking a lot of this expenditure. Indian private sector also, because capacity utilization in the economy has gone past its long-term average. There are lots of sectors at 75 and 80%, which need to do increase capacity. And already you are seeing on the projects under implementation, the blue line shows the private sector's, is in the rise, as well as new investment projects. Also, private sector is in the rise. So private sector capex has also started. In addition to which, there's foreign development, foreign direct investment coming in through the PLI scheme, which through about 14 such industries, which the government as part of the China Plus One strategy has given approval for, about 2.3 lakh crore, the bottom right, second last column total, is the kind of capital expenditure expected in these sectors to come and set up those factories. And that will give a boost to India's capex story. And so many companies have already, under the approval by the government, set up shop in India already. So the PLI scheme is off to a very good start, right? So as a result, if you see from an FDI flow perspective, the orange line, which is the consistent line for India, right? is the one which is consistently steady FDI flowing in. Brazil has gone up and come down and going up, but the consistent growth, you see, India has been the favored country in terms of FDI flows. This is partly driven by the PLI schemes efforts, right? So as a result, to sum it up, the economic activity tracker is telling you that in the coming months, our GVA is going to be on a rising trend. This has the ability to predict the GVA, and it's what it's saying is that in the next few months, our GVA is going to come out even higher than before, right? And so, from a probability of a recession perspective, if you look at all the countries of the world, they're all at a different percentages, with the Germany being at about 75%, but India is at the negligible, close to zero probability of recession for India, right? And so even this year, if you see the comparative growth of India, the yellow line is India. We are the ones consistently maintaining a growth rate of 7%, whereas all other economies are far below us in terms of, and they are revising their estimates downward and downward and downward, whereas our estimates have been consistent. In fact, India is expected to be among the fastest growing countries in this year as well as the next year, in terms of even a growing country like China is going to not grow as fast as India. So from that perspective, if you look at it, our PMIs, when compared to the world PMIs, we are the ones consistently in green, where others are slipping into the red. This is the manufacturing PMI, and this is the services PMI. So clearly, to summarize, right, with such a recession probability being close to zero, the world may be going into recession. And like I say here, that in the land of the blind, which is the world in a recession, the one-eyed man, that is the India, is the king. Why do I call India one-eyed man? Because the US recession and the European recession will affect our economy to some extent. It's not like we can be bouncing and growing consistently. There will be exports will suffer. But like I said, the investment side story of India is a domestic-oriented story. And I think that's one which is going to hold up India's GDP growth. And so I believe that India is in a sweet spot as far as investment is concerned. And now if we shift our focus to earnings for the stock market and look that the Nifty's earnings are actually projected to grow at 22% per annum over a 4-year period, and the actual corporate profits of India are set to double from 5 lakh crores to 10.5 lakh crores in this financial year by the end of March. So this indicates that healthy corporate profits are going to drive your stock market valuations upward. You look at the valuations, the recent correction and the bounce back and the correction, the Nifty is still trading at its long-term average. The green line on top and the blue, purplish blue line on the bottom are plus or minus one standard deviation, right? So the Nifty is trading exactly. So the scope for the Nifty to go to one standard deviation above or even two standard deviations above, which happened in 2018-19, is there. So there is enough room from a valuation perspective for the markets to rise further. And if you see the future of the flows, right? So every year from 2019, 2021, we have seen flows which have been on a positive note. This year was a negative, but as you can see, it's bottomed out in a U and started going up. So from a perspective, right, October to June, we saw 2.5 lakh crores worth of FII money go out of India. Quarter to date, up to September 15th, 69,000 crores had come in. You saw that this last week had seen $3.5 billion go out. So you can subtract 68 minus 3, about $65 billion is what we have got. So almost 1.9 lakh crore of FII money which went out from India can come back. And why do I think this? Yes, some amount of this money with the US rate hike would have gone back to the US. But a lot of the money from India, when it went out, the 2.5 lakh crores, went from a commodity importing market like India to commodity exporting markets like Brazil. So when the commodity prices start declining, people will tend to shift their money from a commodity exporter to commodity importer. So this 1.9 lakh crore represents the potential quantum of FPI money that can return to the Indian markets and support the markets. And what is this based on? Based on the fact that long-term FII money coming to India is based on the future economic growth potential of India and not short-term commodity prices. So if you now look at this graph at the left, that's the year 2006, India was ranked in total GDP in the 14th ranked in the world. And if you then track India's growth, which is the light purple line, you will see that by 2021, today, we are equal to France and just below UK. And in the subsequent days, we have overtaken UK, as you would have read in the newspapers, because UK has seen a strong currency erosion. These numbers are in dollars. Some currency erosion, whereas India has been a strong growth rate. So we have already overtaken UK. And by 2031, that is the end of this decade, India will be in a position to overtake Japan as well as Germany and become the third largest economy in the world. It is this growth potential of India which is making that at least 35% of our market ownership with FIIs right from 2006 onwards. So news of commodity deflation and all is going to get a further boost for hot money flows into India, and hence the Indian stock market is set to be the beneficiary of an increasing amount of FII flows, and which will give support to the market, right? That's exactly what I'm saying here, that India will continue to be magnet, not only for FIIs in equity, FIIs in debt, because as you have read, there is a strong chance for India getting included in a global bond index because Russia was likely to go out and India so far not been there, but the good economic prospects means they're considering India. When that gets implemented, maybe the next 3 to 4 months, you will see debt FII money also come back. You would have remembered that about $14 billion of debt FMI went out from India because of the interest rate scenario. So that coming back will again be a big boost. Plus the story on FDI, you've already seen, we are among the fastest growing FDI recipient nations. So hence, this is an excellent time to invest in equities from a medium term perspective. And hence, whatever correction that you see, it's essentially a bull market correction. Every bull market in its rise stops to take breath. There is a correction for a few days and then it gets fresh, renewed energy. There's enough juice in the long-term India story. There's enough juice in the commodity price erosion corresponding to a recession for the stock market to continue to receive flows and take the bull market forward, right? So in that sense, it's the right time to invest also in a broader market space. Why? Because the short-term volatility, the return of FIIs will favor large caps, but the medium-term growth prospects will mean that EPS growth of mid and small caps will rise faster than expected and hence will favor mid and small cap stock prices. So this is what these tables are attempting to show you. If you split the Indian market into bad economic times and good economic times, the green being the good economic times, you will see that in good economic times, which is called virtuous cycles, the small cap index has always beaten the mid cap and the mid cap has beaten the large cap. Whereas when economies go through a bad cycle, that's when the story tends to get reversed. As I would have told you, the investment cycle is largely going to be a mid and small cap oriented cycle, and hence in this period, you can expect mid and small caps to broadly outperform large caps in that sense. And this happens because of an expansion in their valuation and an EPS growing faster than expected, which is what the table below is trying to show you. From 2017 to now, from the previous peak of the market to now, you see large cap EPS has grown 40%, mid cap by 60%, and small cap by almost 50%. So this combined with the expansion in the PE ratio, which is 3.5, 1, is combined to give you the returns of the stock market. And hence, if you see today, the mid cap index is trading at a 5% premium to the large cap. The small cap index is trading at a 6% discount to the small cap, to the large cap. So from that point of view, like in a virtuous economic cycle, which we expect over the next half a decade or full decade, you will see that we expect the broader market to do better than the larger cap market, right? And hence, to summarize, in terms of the sectoral outlook, given the anticipated recession happening and the cap goods cycle happening, the left-hand side tells you in green where as Sundaram Mutual, we are overweight on a particular sector. The red indicates we are underweight and a white color indicates we are neutral. And this tells you clearly that banks are a key overweight, automobiles are a key overweight, and the construction segment and the industrial manufacturing segment are a clear overweight from our perspective, and the other sectors that are underweight. And I've given you the stock market performance of many of these sectors to tell you that our IT underweight status is reflected in the strong correction that's happening in the IT sector. As you can see, 1 year IT is down about 24%, whereas you can see that wherever auto and all are at 28% up. So basically, our thought process is broadly in alignment with that. The bank X, if you see 1 year is only about 4.5%. We believe that low growth that's shown in the past 1 year is because FII money pull out means 35% of a large cap index is there. But we believe that banking as a sector is probably going to be a key growth area for the coming period, right? So if you compare our sectoral performance versus the US sector's performance, you can see that in healthcare, IT, and real estate, right? The negative in healthcare and IT is because of the fact that India exports these to the US, and hence in a recession, you expect demand to come down in those sectors. And hence the US stock market is also reflecting negative. We are also negative. But in real estate also, if you see that the rise in the interest rates in the US is hurting the prospects for that sector. Whereas if you see on the right-hand side, consumer staples, materials, financials, discretionary consumption, communication, and industrials, in all of them, India is outperforming. In fact, is on a positive growth in terms of the sectoral prices versus the negative growth in the US. Right? Thank you very, very much for your patience.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.